Rule number 1, don't lose money. Rule number 2, remember rule number 1. Disclaimer, the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk. Dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. We are in the middle of a mini series to start the year on the right foot. How are you doing, Véronique?
I'm doing good, Mike, but hopefully my voice will keep on going for the rest of the
You
episode.
never know.
I feel like it's getting tiring a bit, but I mean, we're on a roll. I really want to provide listeners with as much as we can, so let's do this. Yesterday, we talked about what impacted the stock markets in 2025. You can go back to any episode of this series at thedividendguyblog.com/261. Now, Mike, with investing themes also comes some risk, and this is what we will touch on today.
Yeah, so sooner or later, we're going to have a correction, right? I mean, that's the least that we can have. So a correction, just to be clear, is when the market goes down at least 10%. The most pessimistics of us will say that we're going to have a bear market or a crisis. So bear market is at least 20% down from the peak value. Crisis would be anything that we had since, I don't know, like 2008 financial crisis, where the market was down almost 50% at one point, and it took like 4 years to recover, 4 or 5 years to recover. Same thing that happened in the dot-com bubble as well. So we're not talking about Liberation Day here and a few days of volatility. We're talking about something that is very heavy, and it's long, and it's daunting, and it's not fun, and it's discouraging. And this is what we're talking about today. How can you protect your portfolio against all those great news coming up?
So, Mike, 2025 has been greatly influenced by AI. How is this becoming a risk for 2026?
So personally, I don't think we have hit the bubble yet. But on the other side, there are a few concerning factors. The major one is we are seeing massive investment into the infrastructure. And then a lot of investors are asking, well, are we overspending? Because this is exactly how the tech bubble burst. I mean, yes, there was a big part of the tech bubble that was just like Mike.com and Vero.com, like not selling anything and just page views and clicks that went bankrupt. But there was also the other part of like great companies like Cisco, for example, investing massively to build the internet backbone. And eventually, I mean, it was the right move to do, in a sense where we needed this infrastructure to build the internet, and we're still using that infrastructure today. But the thing is, it was too fast, too soon. And maybe this is what's happening with artificial intelligence. So a lot of investors are asking, well, where's the profitability in all this? And yes, we have like companies like Google or Microsoft that are generating so much cash flow that they could spend billions into AI infrastructure, and they're still going to, makes the end of the month and still generate tons of cash flow anyway. But it could have a big impact on their valuation. And on top of that, we also have strange deals that are being done about selling chips and partnerships between companies like NVIDIA, OpenAI, Oracle, Microsoft, Broadcom, and so on. And they're kind of like all intertwined, and sometimes you it looks like a spider web to try to identify where the money is coming from and where it's going. And this is usually the start of a bubble when it gets too complicated like this and it's not straight as usual. So definitely, even though I don't believe it's going to happen, I think that's still a valid risk in 2026 and should not be discarded from the.
Right. And I just want to add quickly something like you always say that a market crisis usually starts in a specific sector, but the way it's going right now, AI is touching pretty much every sector. So if a market crisis happens because of AI, it's gonna be very bad.
That kind of makes sense when you think about it with the domino effect, right? So you're going to have like the tech companies is going to start struggling, and then it's going to go down on building data centers that is not going to be a tailwind anymore, and then lack like we're not going to need that much of energy, and you can see all the dominoes like falling one after the other, and it makes a perfect scenario for a market crash. But keep
Mhm.
in mind, we have a perfect scenario for a market crash every single year, so it's just
Right.
that,
That's
yeah.
true. All right. So, which companies did well before AI, and is there still room to grow for them?
There are plenty actually that did well before, and I believe they will continue to do well after. So, Alphabet, and one thing about Alphabet that I really find interesting is it's kind of like the only player that is vertically integrated because they're making their own chips and they're not selling them that much right now. So, it's only for their own usage. So, they're less dependent on NVIDIA. They have their cloud services, they have their data center, and they have their language model. So they are present in AI at each and every single step, which makes them very interesting play, I think, moving forward. And of course, I mean, it's not surprising. A lot of people have Alphabet in their portfolio, and it's a big winner of 2025, but they
Mm,
were still killing it with their ad revenue model way before that. So I'm not too worried
right.
about this one. For Broadcom, I've been talking about this one for so long. I finally have it in my portfolio, so super happy. But Broadcom is known to grow by acquisition. They have a solid cash flow base coming from their RF filters that is improving a smartphone connection. So definitely that part of the business is not going away. And what they do related to AI, to make it simple, is when you think about AI, you think about like millions of calculations, and you need to those calculations to be done fast. And
Mm.
Broadcom is building highways for those calculations, literally. So, who doesn't want to have faster calculations in a more efficient way, regardless of AI? So, this is what Broadcom does. So, it kind of like has a pretty good niche there. Microsoft, that has multiple growth vectors that are not necessarily related to AI as well. And finally, Apple, that ironically is kind of late into the AI game, so they still rely on their iPhones, they still have their ecosystem. So it's about adding a little bit more AI into their products, but they could do well without it as well. So I'm not really worried for those big.
Okay, so there has also been a lot of commercial tension in 2025, which will be a risk this year. Which sectors are more at risk, Mike?
Definitely consumer sectors, so cyclical and discretionary. We have the tariffs, we have potential economic slowdown. Consumers have been tight with their budget with inflation. I mean, yes, now it's back under control, but prices are still up. I mean, they have not gone back to 2019 levels, and it's never going to happen. So now we have to deal with that as well. So all thing consumers could be a source of a problem. Industrials, of course, everything that is like supply on the supplier side, or transportation. Because, of course, if there's an economic slowdown, well, trucking companies, railroads are going to take a hit. So you have a lot of great companies actually in the consumer, cyclical, discretionary, and also in the industrial sector that could take a hit. So we're going to test a little bit more investors' patience in 2026 if it ever happens.
And now the big question, Mike, is it finally the year of your recession prediction coming true?
Yeah, I mean, one day it's gonna rain, right? Or should I say it's gonna snow? But anyways, we're in the fourth year now, I think. I don't know. I don't want to count anymore. Don't hire me as an economist. But the funny part is, even though I expect that every year for a while now, I don't change my portfolio for that. I just want to make sure that I'm ready to see that
Right.
volatility coming. But yeah, I don't know. I don't know if I should talk about it anymore, but we do have a few signs. But I said that last year and it didn't happen. So I don't know what to say anymore. Can we just move on, please?
I will help you out here. Every 4 or 5 years, we hear about a gold comeback, and I know
Ah,
how
yeah.
much you like gold. This time, though, it is linked with the debasement trade. What does it mean, and how is it related to maybe a recession?
Yeah, so first things first, big comeback in 25. That probably actually started probably late 2024. And the additional thing that is fueling this growth right now around gold is the fact that a lot of investors have less confidence in fiat currency and the government. Because, I mean, right now the governments are getting into more debts, they're printing money, and I mean, their budgets are out of control. So at one point, people are saying, well, if government keeps on acting this way, it's going to devalue the money that we have. So a good move is to seek for a store of value, and gold has been known as the ultimate store of value. So here you have your story. So some people are afraid of a market crash, a recession, and then you see governments that are not doing, I mean, they're not necessarily responsible with their money, we're going to put it that way. So all of this combined together push a little bit more investors toward the yellow metal. Again, if you have been investing in this over the past 18 months, you made a killing. But it goes from time to time, and after that, we know what's going to come up next. It's going to slow down. That's why I don't necessarily like it, but I totally understand people that are going in and out of gold and making a killing when it happens.
Finally, markets keep delivering double-digit returns, which often leads to the risk of chasing returns or yield. Why is it dangerous?
Well, when you chase returns, you get outside of your strategy. And that is quite dangerous because now you're just trying to invest like out of like FOMO, out of fear of missing out. So you just want to get in
Mhm.
the AI wagon. You want to benefit from gold. You want to benefit from whatever happens going to happen next. And you don't necessarily think about how you want to shape your portfolio. You just want returns and you look back, see what worked, and then you try to mimic this going forward, which usually is not like a good way of doing those. When I was a financial planner, we had this chart, and I've seen this chart like being published on various social media where you have the best performing asset each year. So you have like a list of like dozens of assets. You have like T bills, bonds, emerging markets, gold, US market, dividend stocks, whatever. And then each year you see the best performer and the worst performer asset, and it's never the same. Like the order is always it's a colored one. So you have like different colors, and literally over like 10, 15 years, it's just like a bunch of squared different colors every time. So a winning asset class will be a losing one the following years or 2 years later. So if you're trying to chase the returns, you're probably not going to get much out of that. And on the other side, if you focus on yield, that's even more dangerous right now because getting a yield above 5% while everyone is investing like there's no tomorrow today, and the demand for investment, the appetite from investors is huge. Only the bad stuff almost is at 5%. And of course, there are exceptions, but it's just that if in the perfect world where we've been in a bull market for the past 3 years, interest rates are relatively low and the enthusiasm is around every corner of the street, well, what's going to happen when the economy really slows down and we hit a brick wall? Well, dividend cuts are going to happen and the high yielders are going to be first row to cut it off. That story happens all the time. Every time we see the market dropping rapidly, of course, it's because it's backed by some economic data and has an impact on some companies. And the companies that were struggling, I mean, they just do the responsible thing to do and they cut down on their expenses. And the dividend is part of those. So if you chase returns and
Mm.
chase yield, you put yourself in a very vulnerable situation in 26.
So then, Mike, what's the best way to protect our portfolio in 2026?
Certainly not to stay in cash, because those who did that in 25 or 24 probably paid a steeper price than being invested. The point here is to know your exposure to risk. So we're talking about asset allocation, sector allocation, and stock allocation. I mean, we're not reinventing the wheel here, but so many people tend to forget that if they are all invested in stocks, it is quite possible that one day they're going to be down 35%. I've been invested in 100% in equities for the past 23 years, and I know that this is something that could happen at any time, and I don't mind. But some people, that comes up as a surprise. So you have to be sure that you understand what is the implication of your allocation at this point. Having clear buy rules and sell rules. The classic, oh, I'm going to wait until I'm going to reevaluate every quarter. Those are just like synonyms of like, oh, I'm not going to do anything. I'm going to wait and I'm going to get stuck in hesitation. This is probably not the best way to approach a new year. You want to approach a new year in full confidence in your holdings and in your strategy. So don't copy someone else's idea. You can always copy their ideas, but you cannot copy their conviction. And when the shit hits the fan, you need conviction to go through it.
All right, so thank you, Mike, for highlighting these risks to us. Listeners, you already have like good tools after this episode to protect your portfolio, but you can get even more by joining us for our webinar on investing in 2026 at thedividendguyblog.com/webinar. You will get access to the live session on January 8th at 1 p.m. Eastern Time, or get the instant replay in your email. It is also your chance to ask your questions to Mike, as we always keep a minimum of 1 hour of live Q&A session. For our show notes and the complete series, visit thedividendguyblog.com/261. And until tomorrow, stay invested.
Stay invested. Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk, dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time.